Okay, so we're always on the lookout for those hidden gems, right? Those companies that Wall Street might be overlooking. And this time, you found a couple that really jumped out at me.
Yeah, these two are interesting.
We're diving into two dividend stocks today. Alliance Resource Partners, ticker ARLP, and CVR Partners, ticker UAN. And the numbers that caught my eye right away, well, it's got to be those free cash flow yields.
They're pretty impressive, right?
Yeah, we're talking 26% on the low end, all the way up to 33%. So the big question we want to tackle today is, why are these companies flashing these signals? Could they be set up for some really big returns, maybe even doubling your investment?
Yeah, when you see a company putting up numbers like that, free cash flow yields that high, I mean, it's kind of like finding a $20 bill just lying there on the sidewalk, right? You got to stop and think, what am I missing here? And for anyone who's maybe not as familiar with this metric, free cash flow yield is basically how much cash a company's got left over after they've taken care of their operating expenses and any big investments they need to make. And then you express that as a percentage of the stock price. So it's really telling you how much cash you're getting for every dollar you invest in the company. And in this case, yeah, those yields are definitely attention-grabbing.
Definitely eye-catching. And, usually when people hear high-yield dividend stock, they picture this big, established company that's not really growing that much anymore, kind of like high income now, but maybe not a lot of price appreciation down the road. But what makes ARLP and UAN so interesting is the argument that they might actually break that mold. They could be offering both, a nice income stream and a real chance for some significant capital gains.
So that's our goal today, right? To figure out why these two stocks are being talked about as potential hidden gems, companies that Wall Street might be starting to wake up to. Let's start with Alliance Resource Partners, ARLP.
All right, let's break it down. Alliance Resource Partners, ticker ARLP. They've got a free cash flow yield right now hovering around 33%, a dividend yield close to 15%, and their market cap is about $2.5 billion. And just to clarify, market cap, that's basically the total value of all their outstanding shares. Now, the first thing that might stand out to people is that they're a coal company. But this isn't necessarily the image a lot of folks have in mind when they think about coal, right? Yeah, that's a big point that the source material really hits on. This isn't your typical struggling coal company. They're actually considered one of the more profitable players in what's left of the U.S. thermal coal market. And even though a lot of investors have moved away from coal, especially those who are focused on ESG investing, which takes into account environmental, social, and governance factors, it seems like ARLP has been pretty successful at generating cash and sharing it with their investors through those pretty impressive dividends.
And the scale of the cash they're pulling in is pretty remarkable. They're projected to generate over $800 million in free cash flow in 2024. And remember, their market cap is only $2.5 billion. So as the article points out, that means theoretically they could buy back a third of their own stock every year if they wanted to. That just highlights how much cash they're actually generating. And I think part of the reason this is being overlooked is that a lot of investors tend to lump the entire energy sector together. So they might miss the specific details of ARLP's contracts and the fact that there's still a demand for thermal coal in certain parts of the world, even if it's potentially declining.
And they're not just hoarding all that cash either. They're paying out a pretty hefty dividend, currently around 14.8%. And the article even suggests that there's room for that dividend to grow. And this isn't being presented as one of those high-yield traps where the dividend looks good on paper, but the underlying business is shaky. The argument is that ARLP has low debt, stable operations, and most importantly, they've got these long-term contracts with utilities that are still using thermal coal to generate a lot of their electricity.
Right. Those contracts are key. They often have long terms and sometimes include mechanisms that protect ARLP's revenue, even if coal prices start bouncing around. And it's important to remember that coal prices haven't actually collapsed. They've stabilized. And that stability allows ARLP to operate like a well-oiled cash cow, focusing on profits from their existing assets without having to make huge new investments. Right. And that just amplifies their free cash flow.
So considering all of that, let's get to the heart of the matter. Why could a company like ARLP potentially double in value? The first point the article makes is just how cheap it seems to be right now. We're looking at a price-to-earnings ratio under 4, and the price-to-free cash flow is even lower. And just for some context, the price-to-earnings ratio, that basically compares a company's stock price to its earnings per share. So it gives you an idea of how much investors are willing to pay for each dollar of profit. Similarly, price-to-free cash flow tells you how much you're paying for each dollar of that free cash flow. And in this case, both of those ratios are screaming undervalued.
Yeah, those are some seriously low multiples, especially in today's market. And if we zoom out a bit,
A big chunk of the broader market is trading at much higher valuations. So the argument here is that even a small upward revision, or re-rating as the article calls it, could lead to some pretty significant gains. Specifically, they suggest that if the price to free cash flow multiple were to just double to 8, the stock price could potentially double along with it. Now, this re-rating could be triggered by a number of things, like maybe continued stable coal prices, showing that their business model is resilient. Or maybe as investors get more concerned about inflation in the broader market, they might start looking for value and high cash flow in those less glamorous sectors.
And the potential upside doesn't stop there. The article suggests that if you factor in even a little bit of expansion in those valuation multiples over the next few years, combined with reinvesting those juicy dividend payouts, the total returns for investors could be pretty impressive. They even use the term generational returns over the next 3 to 5 years. Now, they do acknowledge that the long-term trend is moving away from coal, but the idea here is to capitalize on what could be a very profitable opportunity in the near to medium term. Okay, let's shift gears now and talk about our second company, CVR Partners, ticker UAN.
All right, so CVR Partners UAN, it's an interesting contrast to ARLP. It's another commodity-based business with a high free cash flow yield, somewhere around 26%. But instead of coal, their game is nitrogen fertilizer, which is, kind of essential for agriculture and feeding the world. Their dividend yield can vary, but it averaged over 20% in 2023, and their market cap is quite a bit smaller than ARLP, sitting around $750 million.
Right. And the fundamental driver of demand here seems pretty simple, right? The article puts it nicely. As long as people need food, farmers need fertilizer. So there's this really strong underlying demand for what UAN produces, especially in a world where resources are becoming more and more important.
Exactly. But here's the thing that's so interesting. Even with that seemingly solid demand, the market doesn't seem to be buying it. The article argues that UAN is trading almost like a company in distress. And they point to a few reasons for this potential undervaluation. Its smaller size, less trading liquidity, meaning its shares aren't traded as often as bigger companies, and the fact that the fertilizer industry is known for its ups and downs, those cyclical periods of high and low prices.
So even though they're a crucial part of the agricultural supply chain, those perceived risks and the way the industry works seem to be holding its valuation down. But just like ARLP, UAN is also generating tons of free cash flow. In 2023, they pulled in $200 million with that $750 million market cap. That's another case where, theoretically, they could buy back a huge chunk of their own company each year if they wanted to.
And again, they're choosing to send a lot of that cash right back to the shareholders through those big quarterly distributions. The article points out that when times are good for fertilizer prices, the dividend yield can climb north of 20%. And even when fertilizer prices are less favorable, UAN is still profitable. They achieve this through efficient production and relatively low costs when it comes to expanding their operations.
So let's dig into the why it could double argument for UAN. The first point revolves around the fact that the fertilizer market is cyclical. Right now, it's in what's being described as a down phase, but the article mentions that commodity prices have already started to show some signs of life, of a potential recovery.
Yeah, that's a big deal. As those fertilizer prices start to climb back up, UAN will be in a better position to charge more for their products, which should lead to even more cash flow. And if we connect this to the bigger picture, the ongoing issues with global supply chains and the wild ride we've seen with natural gas prices, which is a key ingredient for making nitrogen fertilizer, all of that could push UAN's profit margins even higher.
And the article makes this interesting point. UAN doesn't even need a full-blown fertilizer boom for its stock to double. If the market simply stops treating it like it's on the verge of collapse, that alone could be enough to spark a major revaluation.
That change in perception is key. If the market were to just re-rate UAN from its current free cash flow yield of about 26% to something more in line with the rest of the market, let's say around 13%, which is still a pretty good yield, that alone could double the stock price. And then when you add in those hefty dividend payments over the next 3 or 4 years, the potential for a 2 or 3 times return on your investment starts to look really tempting.
Now, we absolutely have to talk about the risks here. The article is very clear that these aren't your typical set-it-and-forget-it investments.
No, definitely not. Both ARLP and UAN operate in industries that are inherently cyclical, and they can be pretty sensitive to changes in regulations and politics. With ARLP, you have to consider the possibility of new regulations affecting coal production or its use in power generation. For UAN, swings in natural gas prices and global agricultural commodity prices are major risks, and a general economic downturn or recession could also dampen demand for both coal and fertilizer, hurting their cash flow. So it's a good question for anyone listening. How comfortable are you with these sector-specific and broader economic risks?
That's a crucial question for any potential investor to ask themselves. And it's important to remember that both ARLP and UAN are structured as master limited partnerships, or MLPs. This is a specific kind of business structure that impacts how they're taxed. Investors in MLPs receive a Schedule K-1 form for tax purposes instead of the usual 1099. And there could be tax implications if you hold these in certain retirement accounts, like an IRA, because of something called unrelated business taxable income, or UBTI.
Yeah, those tax implications are definitely something to consider carefully. It might even be worth talking to a tax professional about it. But the article does mention that for investors holding these stocks in taxable accounts, the potential returns could be huge if everything plays out the way they're predicting.
So as we wrap up our deep dive into ARLP and UAN, it's clear that we're looking at a pretty unique situation here. In a market where a lot of companies seem overpriced and dividend yields are generally low, finding companies with free cash flow yields over 26% that are also returning a good chunk of cash to shareholders is definitely something worth investigating further.
What's fascinating to me is how different this is from the typical market narrative.
Yep.
These aren't the flashy tech companies that everyone's always talking about. They might not be the hot topic at the next big investment conference, but they do have the potential to generate a lot of real tangible cash flow compared to their current value.
Exactly. If you believe that free cash flow is the engine that drives long-term investment returns, then these companies, as the article puts it, are pumping it out like crazy. And the main argument here is that it might not take a massive market shift to unlock their potential. Maybe just a little change in how investors view these overlooked sectors, or a bit of upward movement in their commodity prices, could be enough to push these stocks significantly higher, maybe even to that doubling point we've been discussing.
So here's something to think about as you digest all of this. When you look at your own investment portfolio and your goals, what kind of impact could one or two well-timed investments with the potential for this kind of upside have on your overall returns? It's a reminder that sometimes the most interesting opportunities are hiding in plain sight in those areas that aren't getting all the attention.
Great food for thought.
Yeah.
Thanks for diving in with me.